Hello everyone, I am Kenshin. Welcome to Talking History. Please move your fingers to subscribe, like, leave a message and share. Please also turn on the little bell. Thank you. Today's history chat is the history of credit cards and bank traps. I believe that everyone in modern society may have more than one credit card for themselves or their family members, but have you ever thought about when credit cards appeared? How does it occupy an important role in modern social transactions? In addition, do you know how many traps banks set for credit cards, and how to avoid them? Tell you once today. The earliest recorded forms of credit cards in history were discovered in ancient Mesopotamia. These cards were actually clay tablets, considered as credit limits and used for transactions with neighboring civilizations. Reports from the American Institute of Archaeology show that ancient Mesopotamians inscribed detailed contracts, commercial information, and financial transactions on these clay tablets. These well-preserved tablets can be traced back to nearly 5,000 years ago, showcasing how early commerce operated worldwide from around 2000 BCE to 1750 BCE. Essentially, these early credit cards facilitated the transfer of official money and goods, sometimes promoting these transfers through debt and for commercial purposes. Other forms of credit limits were utilized throughout ancient civilizations and early modern periods. Some may consider them precursors to the credit cards used today. For example, a form of borrowing currency known as credit certificates emerged in Europe in the early 1800s. These certificates were purchased from banks and provided as a payment method for goods and services to others. If the borrower failed to fully repay the credit certificate, the bank had to guarantee payment, charging fees to the buyer to cover the risks involved. As for how credit instruments operated at the time, consider a consumer in the 1800s traveling and wishing to purchase goods such as furniture, sugar, or wheat with foreign currency. They could have the bank issue a letter of credit to the merchant for payment instead of paying the merchant directly. The buyer then owed the bank the borrowed amount plus credit certificate fees. However, if the buyer vanished without fulfilling the agreement, the bank ultimately had to settle the bill. The early history of credit in the United States began in the late 1800s, with stores issuing paper, loyalty cards, serving as some form of credit limit. In 1914, Western Union introduced a product called metal currency, which later became one of the earliest consumer credit cards. These metal plates essentially allowed consumers to defer payment for part of their debt, similar to the credit cards and credit limits we use today. In the 1920s, individual companies like oil companies and chain hotels also began issuing credit limits to consumers in various forms. Then, in the 1930s, something called a chaga plate began to circulate. Each chaga plate was a rectangular metal plate measuring 2.5 inches by 1.25 inches, used to record customer information such as their name and address. Customers would also sign a small paper when using the chaga plate for purchases. According to the National Museum of American History, chaga plates were developed as early as 1928 and were issued from the 1930s to the 1950s. The next generation of modern credit cards appeared in 1950. That year, a businessman named Frank McNamara forgot his wallet while dining out in New York, leading to the creation of the Diners Club card, touted as the first multi-purpose charge card. McNamara and a partner devised a solution to help Americans avoid similar embarrassments, leading to the creation of the Diners Club card. According to Diners Club International, membership in the card expanded to major cities and reached 42,000 within the next year, continuing to grow thereafter. American Express was one of the major banks to issue its own charge card, which it did in 1958. Public interest was so strong that 250,000 cards were issued before the official launch, despite the card's high annual fee at the time, which was $6. According to the Encyclopedia Britannica, in the same year, Bank of America introduced a product targeting California, entering the credit card field. Subsequently, in 1966, Bank of America's card product was licensed and used in other states, eventually renamed Visa. The Encyclopaedia Britannica's data shows that many initially small-scale or regional bank credit card programs later became part of major national bank chains, meaning credit was no longer restricted by location. In 1966, a group of competitors formed the Interbank Card Association, ICA, which eventually became the MasterCard International Organization. Shortly thereafter, ICA collaborated to launch MasterCharge, renamed MasterCard in 1979. MasterCard and Visa are the two largest credit card networks in operation today, but American Express and Discover also operate cards. American Express issued the first plastic credit card in 1959, and Diners Club began issuing plastic credit cards in 1961. The magnetic stripe on credit cards was created by IBM in the early 1960s as a means to store customer and transaction history and information. The birth of the magnetic stripe came about as IBM engineer Forrest Parry endeavored to figure out how to use credit cards to store and transmit data. His wife, ironing at the time, suggested he iron the necessary storage components onto the credit card to melt them. This proved effective. A series of credit card legislations helped shape the credit card market as we know it today. Most legislations were passed to protect consumers from predatory practices. As detailed in the North Carolina Law Review, racism was rampant in the early credit card industry. It wasn't until 1974 with the passage of the Equal Credit Opportunity Act that race-based credit decisions were prohibited, along with the practice of requiring women to have male co-signers to obtain credit cards. This includes laws like the Truth in Lending Act of 1968, the Fair Credit Billing Act of 1974, and the Equal Credit Opportunity Act. Despite their convenience, credit cards still harbor many pitfalls set by banks. 1. Minimum monthly payment amount. The method for calculating the minimum monthly payment amount varies among card issuers. Some charge 2% to 3% of the balance, while others charge 1% of the balance plus any interest or fees owed for the month. Paying only the minimum amount is a debt trap, as it could take years to repay the substantial balance accumulating interest. Preventative measure. If you cannot pay the full monthly balance, pay as much as possible above the minimum limit. 0% interest. Some credit card promotional offers do not charge interest on new purchases, balance transfers, or both within a specified timeframe, e.g., 12 or 18 months. Since issuers are not required to notify you when the promotion ends, track the dates yourself. If you still have a balance when the promotion ends, you'll be charged interest at a new rate, which could be high depending on your creditworthiness. Preventative measure. When transferring a balance to a 0% interest card, ensure it's paid off before the promotion ends. 3. Deferred interest. According to Wallet Hub, over half of retail credit cards offering interest-free promotions also feature a function called deferred interest. This means if you delay payment or still have a balance when the promotion ends, the issuer will retroactively charge interest on your purchases. Preventative measure. If you cannot pay off the balance before the end of the promotional period, think twice before purchasing products with deferred interest. 4. Cash advance. Credit card cash advances incur certain fees, usually $10 or 5% of the advance amount, whichever is higher. You'll also face a higher cash advance interest rate, typically around 24%, and interest begins accruing immediately. Prevention. Consider cheaper loan options like personal loans from banks or credit unions, or borrow from family members at lower rates. 5. Cash and travel bonuses. Some cards offer cash or travel mileage bonuses on your bill if you spend a certain amount within the first 3 months of account opening. Prevention. Ensure the card aligns with your spending needs to avoid excessive shopping for bonuses, which may even increase interest. Also, review other terms of the card. Some charge annual fees, which can erode the value of bonuses. 6. Changes in terms. Your issuer must notify you at least 45 days before significant changes in terms, such as fee or rate increases, take effect. However, They are not required to notify in advance for changes in reward programs or reductions in your credit limit. Prevention. For example, has your issuer increased your rate due to late payments of 60 days or more? If you've made on-time payments for 6 months, your old rate may be reinstated. Verify directly with the issuer.